Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 155, and in this episode we are reviewing the performance of the global markets during the 15th week of 2025, and that is from Monday the 7th to Friday the 11th of April. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where on Thursday, the Bureau of Labor Statistics reported that consumer price inflation eased more than expected in the month of March as President Trump launched tariffs against U.S. trading partners. The Consumer Price Index, which is a broad measure of the cost of goods and services across the U.S. economy, this fell by a seasonally adjusted 0.1% for the month of March and by 2.4% over the past 12 months, down from 2.8% in February and compared to market expectations of 2.6%. Excluding food and energy prices, the core inflation rate was recorded at 2.8%, which was the lowest core rate since March 2021 and also came in below the Dow Jones consensus estimate of 3%. The introduction of tariffs has significantly increased the likelihood of higher inflation, but this remains uncertain as President Trump has opened a 90-day window for negotiations with other countries, with the exception of China. And an update on the ongoing tariff war. The tit-for-tat trade war between the United States and China has seen total tariffs imposed on Chinese imports rise to 145%, with China responding by raising its tariff on U.S. products to 125%. This level of tariffs is likely to permanently damage the operations of most small businesses and severely dent the outlook for the U.S. economy. According to supply chain executives, the immediate response has been the cancellation of import orders from China and the abandonment of freight containers at U.S. ports. If the status quo persists, it is highly likely that most U.S. businesses will stop importing from China and consider alternative suppliers from other countries. In some instances, however, where specialized goods are not available or affordable from other countries, this could lead to the closure of small businesses in the United States. On Wall Street this past week, the stock market experienced one of the most volatile trading sessions ever recorded. The three major indices tumbled on Thursday as traders went into risk-off mode, driven by uncertainty on U.S. trade policy, which continues to weigh down on market sentiment. In addition, the volatility index, better known as the VIX, which measures volatility expectations, had earlier in the week spiked above 50, signaling increased volatility and the potential for market turmoil. The Trump administration has imposed a tariff of 145% on Chinese goods, and in return, China announced on Friday that it was raising its tariffs on U.S. products to 125%. The stock market, however, recovered on Friday after President Trump said that he was optimistic that China would seek a deal with the United States. And as at the close of business on Friday, the S&P 500 advanced by 1.8% to end at 5,363, whilst the Dow Jones Industrial Average rose by 619 points to end the week at 40,212, and the tech-heavy Nasdaq Composite climbed by more than 2% to eventually settle at 16,724. In the Treasury bond market, the yield on the benchmark 10-year Treasury bond rose by more than 50 basis points this past week after declining to around 4% the previous week to mark one of the largest spikes ever recorded. The steep increase in yields was attributed to inconsistency in Trump's trade policy that caused investors to dump U.S. Treasuries in favor of other global safe haven assets. Traditionally, investors have turned to U.S. Treasury bonds as safe haven assets during times of uncertainty and volatility. However, this time around, investors, including the two largest sovereign investors, that is Japan and China, are now dumping U.S. Treasuries due to the escalating trade tensions. The benchmark 10-year Treasury yield advanced 9 basis points to 4.48%, whilst the yield on the policy-sensitive 2-year Treasury note climbed by 12 basis points on the day to settle at 3.97%. For your information, bond yields and prices are inversely correlated, and 1 basis point is equal to 0.01%. In the crude oil market, the price of crude increased by more than 2% on Friday after the United States said it could end Iran's oil exports as part of an effort to contain the country's nuclear program. Strict enforcement of restrictions on Iranian crude exports could reduce global supply, but this is unlikely to have an impact as long as China continues to purchase Iranian crude. In addition to that, President Trump's unpredictable tariff policy has also forced traders to reassess the geopolitical risks facing the crude oil market. Meanwhile, the U.S. Energy Information Administration has lowered its forecast for global oil demand in 2025 and warned that trade tariffs could weigh heavily on the price of crude oil. Analysts have forecast that oil consumption will decline by 1% if global economic growth falls below 3%. At the end of the week, the price of the global benchmark Brent crude was up by 2.2% to settle at $64.76 a barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, increased by 2.3% to end the week at $61.50 per barrel. In the precious metals market, the price of gold broke above $3,200 on Friday as a weakening dollar and escalating trade tensions stoked fears of a global recession, sending investors flocking to the safety of the precious yellow metal. Gold is seen as the favored safe haven asset as the ongoing trade war has seen the dollar depreciate and U.S. Treasuries have been sold off as faith in the U.S. as a reliable trading partner has diminished. A combination of central bank purchases, together with investor flows into gold ETFs and the prospect of further rate cuts by the Federal Reserve, has supported the rally in gold so far this year. Gold is viewed as a hedge against a recession as well as inflation and tends to thrive in a low interest rate environment since it doesn't offer a regular coupon like a bond. In closing, the price of spot gold was up by over 6% this past week, and after hitting a record high of $3,245 earlier in the session, it eventually settled at $3,235 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenyan shilling depreciated marginally versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.67 compared to 129.25 that was recorded the previous week. Meanwhile, the sterling pound was priced at 166.85 and the euro was valued at 142.54. And on the regional front, one Kenyan shilling was changing hands for 28.57 Ugandan shillings and 20.75 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.05. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by a massive $207 million for a grand total of $9.72 billion, which is equivalent to 4.4 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. On diaspora remittances, the inflow of remittances in the month of March 2025 totaled to about $423 million compared to $408 million in March 2024, which was an increase of 3.7%. The cumulative inflows for the 12 months to March 2025, this increased by 13.5% to $4.97 billion compared to $4.38 billion for a similar period in 2024. The inflow of remittances continues to support the country's current account as well as the domestic foreign exchange market. The United States remains the largest source of remittances into Kenya, accounting for 53% of the total remittances received in March 2025. In the money markets, the interbank market was sufficiently well funded during the week and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined from 10.68% the previous week down to 10.12%, which was in line with the reduction in the central bank rate. And in terms of volume, the average value that was traded in the interbank market, this increased to 18 billion shillings, up from 6.8 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 18.2 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 10th of April, and the central bank received bids totaling to 53.7 billion shillings against an advertised amount of 24 billion shillings, representing a performance of about 224%. The central bank, however, ended up accepting only 43.5 billion shillings, and the results of the auction were as follows. The 91-day rate declined by about 13 basis points to average out at 8.50%, whilst the 182-day rate dropped by 14 basis points to level off at 8.89%, and the 364-day rate fell by 15 basis points to settle at 10.23%. In the primary bond market, during the past week, the central bank advertised a top sale for the recently reopened 15-year Treasury bond, and the auction for the top sale was held on Thursday, the 10th of April, with the central bank receiving bids totaling to 13.2 billion shillings against an advertised amount of 10 billion shillings, representing a performance of 132%. The central bank ended up accepting 12.5 billion shillings at a weighted average rate of 13.66%, compared to the bond's coupon rate at 12.75%. Up next is our topical issue, and this week we are reviewing the decision by the Central Bank's Monetary Policy Committee. The Central Bank's Monetary Policy Committee met on Tuesday, the 8th of April, and reviewed the outcomes of its previous decisions and the measures implemented to anchor inflationary expectations and maintain exchange rate stability. The meeting was held against a backdrop of persistent geopolitical tensions in Gaza and Ukraine, coupled with the prospect of sticky and higher inflation that is driven by the ongoing tariff war, which has raised the level of uncertainty in the markets and raised the probability for a global recession in 2025. And back at home, the Kenyan economy has slowed from a growth of 5.6% in 2023 down to 4.6% in 2024, and despite the challenging economic environment, is still projected to grow by 5.4% in 2025. On a positive note, the overall rate of inflation in Kenya stood at 3.6% in March 2025, which remains below the central bank's midpoint target rate of 5%, reflecting lower food and energy prices, plus continued stability in the dollar-shilling exchange rate. Meanwhile, Kenya's current account, which measures the net position between imports and exports, this showed that the deficit had narrowed to 3.1% of the gross domestic product in the 12 months to February 2025, reflecting an improvement in the value of exports plus consistent growth in diaspora remittances. On foreign exchange reserves, Kenya's holding of foreign currencies was valued at $9.93 billion, which is equivalent to 4.4 months of import cover, and continues to provide an adequate buffer against any short-term shocks in the domestic foreign exchange market. According to the press release, Kenya's banking sector remains stable and resilient with strong liquidity and capital adequacy ratios, and as at February 2025, the percentage of gross non-performing loans increased significantly to 17.2% of the entire loan book in the banking sector. And with non-performing loans on the rise, the risk appetite for lending to the private sector has taken a hit as commercial banks lending to the private sector recorded a measly growth of just 0.2% in March 2025, following a contraction of 1.3% in February. The committee noted that the ongoing implementation of the budget is expected to lower the fiscal deficit to 5.1% of the gross domestic product. This fiscal consolidation should help reduce the debt burden by reducing the debt to GDP ratio from the current rate of 70% down towards the target rate of 55%. To further enhance the effectiveness of the monetary policy implementation framework, the committee approved the narrowing of the interest rate corridor above and below the central bank rate from the current 150 basis points down to 75 basis points. This change will help to align the interbank rate more closely to the central bank rate. And given the foregoing observations, the committee concluded that there was scope for further easing of monetary policy in order to stimulate lending to the private sector and support economic activity, whilst also ensuring stability in the exchange rate. The committee therefore decided to lower the central bank rate by 75 basis points from 10.75% down to 10% flat. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, if you are passionate about your work, then work becomes the reward. Think about it. Thank you, and God bless.